And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Tuesday edition of The Real Investment Show. I'm your host, Lance Roberts. Michael Leibowitz will be joining me live in studio today. Usually he's here on Thursday, but he's actually in town this week, so he's going to be joining me live this morning. We'll talk about the upcoming Fed meeting just right around the corner, May the 5th. The Fed will be announcing their next rate hike, and what does that mean potentially for here? Is it going to be the last one? Or still more to come? We'll get into that this morning. Also, another big news this morning, President Joe Biden has officially announced his re-election bid for 2024. This is going to be interesting. The Democrats have said there will be no debates whatsoever. So this is going to be quite interesting on trying to run for election. Normally you have debates to allow candidates to go head to head with each other. We'll see how this works out with no debates whatsoever, but we'll see how that goes. Outside of that, the markets yesterday, of course, still absorbing earnings between now and May the 5th. Now, remember, May the 5th, Fed meeting right around the corner. Between today and May the 5th, 87% of the S&P 500 will have reported earnings by the time we get to the point to where the Fed hikes rates. And it's really been a mixed bag so far. This morning, futures are pointing a little bit lower. Companies are, kind of hitting the line, I guess you'd say, with earnings estimates. Of course, those have been drastically lowered since May of last year. We went from about $223 a share down to $172. So a big decline in estimates. Companies just kind of a mixed bag of meeting or missing estimates. This morning, good example, McDonald's beat estimates in revenues, Verizon's missed. So, kind of just a question of which company it is and kind of what outlook is. Futures are pointing down a little bit lower this morning, but again, by the time we get to the Fed meeting, we'll have a really good handle on really kind of what the earnings look like for the S&P 500. And most importantly, and this is the thing to watch, and I actually put a chart of this out on Twitter this morning. The one thing that we've been talking about is we already knew that earnings were going to be fairly weak for these S&P 500 companies for the last quarter, but what were they going to be saying about earnings and revenue over the next quarter or the quarter after that? That's actually been rising. So normally when you see a trough in earnings expectations, that's usually coincidence with the trough of the recession. But it's interesting this time, we haven't officially had a recession, although we've had just everything that goes along with a recession, bank crises, market declines, all those type of things. Everything's kind of responded to a normal economic recession. We just haven't officially declared one as of yet. But now earnings are beginning to improve. And now if companies begin to have better earnings going forward, well, that's going to be kind of an interesting situation, considering where we are and the Fed's still hiking rates. Of course, inflation continues to be the big issue at hand, but inflation rates are falling. We're seeing prices paid come down in manufacturing indexes. We're seeing slower consumer spending. Credit card debt on the rise. Oh, by the way, along with credit card delinquencies also on the rise because wages are falling. So again, you have a lot of these kind of coincident indicators that are all impacting the markets right now. Markets really kind of trying to digest this, right? What does the outlook look like for earnings, for revenue growth, for the economy? That's what's going to drive prices. And as we've been talking about here over the last few days, markets really kind of just stuck here in midair. We had this very nice rally back in middle of March. We wrote an article talking about 4,200 on the rally. We talked about this yesterday. We got to 4,168. Didn't quite get to 4,200, but we were close. And really ever since then, the market's just kind of trading sideways here. We're not really making any advances or not really declining. Yesterday, markets kind of sold off early in the morning, rallied back to break even. And that's really been a lot of the action here over the last week. Markets aren't really gaining much ground, but they're not losing any ground either. We're just kind of stuck. And this is kind of a function of where we are at the moment. The market's trying to decide what happens next. That's really where we are. Between now and May the 5th, the market's going to have to make this decision. The MACD buy signal that we had talked about back in mid-March, the reason that we increased our equity exposure back then, is now actually extremely close. And if this weakness that we have kind of priced into the futures this morning remains for the day, we will likely trigger that sell signal today. That should suggest, I'll spit that out, that should suggest lower prices, because typically what you're talking about here is now weakness in the overall market. Breadth has been weak, volume has been tepid. So again, a decline here won't be surprising, and particularly as we get into the summer, which tends to be weaker months anyway. In fact, that's our article that's out on the website today, our Tuesday take, talking about, well, do you sell April instead of May this year and kind of leave early? That's what these indicators are suggesting, is that maybe we could see some weakness over the course of the next month or so. And that would really not be surprising. We've had a very strong buying stampede here. When you have these buying stampedes, they typically get followed by, yeah, you guessed it, a selling stampede, which just like we'd seen back in the beginning of this year, January to February, very strong buying stampede. We had a selling stampede to follow that. Of course, markets declined, got oversold, next rally. That's just the way markets work over time. Wouldn't really be expecting to see anything different here. So as we talked about last week, we took a little bit of our trading index positions off our portfolio, just raised a little bit of cash here, particularly as we go into summer. We want to be a little bit more cautious. And then this will give us time to kind of figure out what's happening with the Fed, what are earnings doing, kind of where the market looks like it wants to head to next. Again, lots of headlines, extremely bearish. Lots of very bearish headlines out there. Bullish sentiment is very low. There's a lot of negative sentiment in the overall market. So again, lots of expectation of another big leg down in this market, kind of this bear market decline that everybody's been expecting, but markets have been really fighting against that trend. Really, ever since last year, markets continue to try to stay up and kind of moving higher. And ever since we saw these lows back in really October, the market has just been kind of this trending higher. And it's just been this kind of grind higher. It's not been a real accelerated move, but it's been a grind higher here as markets continue to just try to work off some of that sell-off that we had early last year. Again, as we talked about in this weekend's newsletter, these rolling recessions, these rolling events, right? We had the Russia war, Ukraine, then we had the Fed tightening, and markets have taken each one of those, have declined, then bottomed, and then expectations began to improve, and prices began to improve on expectation, well, the Fed's going to pivot, or this is going to happen, or that's going to happen. And so we've continued to kind of work through this bad news, pricing in the bad news, acknowledging that bad news, pricing in what the expectations were next. And of course, markets have continued to really, since October in particular, have continued to improve off that low that we saw last October. Of course, back in that October low, we had written some articles talking about the extremely bearish sentiment that existed at that point. Last October, remember, everybody was assuming that we were going to have a very bad recession and that stocks could only go one way, and that was down. And historically, when you get that type of negative positioning, really across the board, you have very high cash levels, very low equity exposure, extremely bearish sentiment, as we wrote back then, that is typically the making of the bottom of the market. And since then, that has so far been that case. But again, that rally from those lows has not been accelerated. It's not been a very fast advance. It's been a grind higher. So again, there is certainly risk here that as we get to the summer months, we are going to see some weaker economic data. We're already seeing that now. But we could see another leg lower, but that's likely going to be confined somewhere to the bottom of these recent ranges, not this big accelerated decline that a lot of people are talking about in the media. So anyway, we've got a lot of stuff to get into this morning with Michael Liebowitz. The Fed coming up May the 5th. Are they going to hike again? Not hike again? Is the pivot finally here? We'll talk about that and more this morning right here on The Real Investment Show. Be sure you go by the website, realinvestmentadvice.com. Our latest blog post is out on the website this morning talking about should you sell in April? That's on the website this morning. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is Tuesday as we get this week underway. Getting ready to wrap up the month of April already. It's amazing how fast this month is going by. Already paid your taxes. Apparently tax refunds are getting delayed, so maybe a while before you get your tax refund back. And it's likely going to be smaller, according to recent statistics, than most people expect. So, again, that is the kind of the issue to pay attention to. Outside of this, a couple of other things that are going on. As I said, Michael Leibowitz in town today, and we're going to be talking a little bit about, normally we talk about the Fed and what's going on Thursdays. So, but since he's in town, we're just going to do it today instead. Coming up on May the 5th is the next Fed meeting. And this is the big issue here, right? So, everybody's wondering, right? Is the Fed going to hike rates 25 basis points? Are they going to pause? Are they going to start cutting rates soon? What's the Fed outlook on the economy? I mean, this is really what the markets are hanging on at the moment between earnings and the Fed. This is where the markets are just kind of trying to get their next cues from. And of course, right now, Fed funds futures, as of a couple of days ago when I checked, were pricing in almost certainty that the Fed was going to hike another 25 basis points. That hasn't changed much yet, has it, Mike?
Yep.
So it's about the same?
Yep, 25. I think what's interesting is we're waiting on the earnings. We're waiting on the Fed, earnings, Fed. But it's really the economy, and the economy is showing signs of stability. It's not dropping off a cliff. It's not surging. It's just going. And a lot of people suspect, including the Fed, they called for a mild recession, that the economy is going to decline. Well, until unemployment starts rising, until people start getting laid off, none of that is going to happen, and we kind of just sit here in this flat economic territory. So I think what becomes important is not even necessarily the Fed or earnings, even though they're both very important, but it's watching the employment data. And the big data comes out the first Friday of every month. That's the BLS report. And that's nice, but it lags. So what we can do to kind of gauge employment in between the reports and get more of a leading indicator is to look at things like jobless claims, continuing jobless claims. So those are people that had already filed for jobless claims in prior weeks, but they still can't find a job, so they're continuing to get claims payments. Those are both good gauges, and both have upticked. On a percentage-wise, they've upticked quite significantly, but they're still at very low levels. So they're not signaling a recession, but the trend is certainly heading in that direction, you could say. And then we look at a wide variety of manufacturing surveys, service industry surveys, to see what they're saying about employment, about whether they're looking for people, whether laying off people, what their plans are. And we can use things like JOLTS and ADP and other sources to try to figure out what the trend is in employment. Because I think if you get the trend in employment right for the next 6, 9, 12 months, you're going to get the Fed right. You're going to get the markets right. You're going to get a lot right. But it's quite possible that employment just lingers. Maybe unemployment slowly trends higher, but it doesn't really clue us in as to whether or not we're going to have a recession till later this year.
Yeah, and that's kind of an interesting, kind of thing when you talk about, continuing claims, because again, as you noted, those are people that are not getting reemployed. So a continuing claim, you file your initial claim, and then when you come back and get your claim the next week, now you're a continuing claim. And to Mike's point, on a percentage basis, they've increased rather sharply here over the course of the last several months. But we're now back to a level, even though those claims remain pretty low, they've risen enough now that they're at a level that rise is normally at a level consistent with onsets of recessions. But again, as we've talked about before, it's interesting because we've had these kind of continued conversations, leading economic indicators clearly in recessionary territory. That's pretty much a prime indicator if you're going to have a recession. Inverted yield curves are at levels that have always been coincident with recessions, but yet we haven't dated one yet, and this is the big cue, right? We haven't dated the recession. The National Bureau of Economic Research is the company or the organization that dates the start and beginning of a recession. They're always late, but economic data in terms of you take a look at GDP now as an example. That what's the Atlanta Federal Reserve? They're predicting fairly decent economic growth for Q1. We had 2 quarters of negative growth last year in the first half of the year, but that wasn't deemed a recession, at least not yet, right?
So, and you know why?
Right.
Because they use employment.
Right. And so it's kind of interesting that we've got so many indicators that are now pointing that say that we either are in a recession or should be in a recession, yet there's a lot of other anecdotal evidence, markets being one of them, earnings improving being another one, that maybe that's already behind us. It's a very interesting situation we're in right now.
Well, part of the problem is what we went through with COVID, where in the aftermath of the initial COVID hit, where many companies, small and big, couldn't hire employees. They couldn't get enough employees. And I think we're still to some degree in that post-COVID shock period where a lot of employers are not willing to let go of employees, even if they're not good employees, even if they're costing money versus helping make the company money. And I just think it's going to take time. This has been 3 years now of COVID, and we're still seeing some of the psychological, sociological impacts, financial impacts, the liquidity impacts are still rippling through the economy, rippling through the markets. And I think employment's another one that we've talked about my brother. He does not want to get rid of employees. He is scared that he will not be able to hire them if the economy starts doing better, if his sales start going up. So, I think we're dealing with numbers, but we're also dealing with a somewhat unique instance as well.
And that's kind of, going to make it challenging for the investing environment that we're in. And I thought this was interesting. If you take a look at some of the recent action in the market, it's been interesting because, earnings haven't been terrible, right? So if we look at earnings, I was talking about this morning, right? So two big companies. You have McDonald's on one hand and Verizon on the other. Now, kind of think about these two companies for a second. Everybody that wants a cell phone or internet service or whatever, right? You just want to talk to somebody. You're going to be using one of the big companies probably at some point. So Verizon, AT&T, et cetera. And yeah, I know there's a lot of other companies like Cricket that are out there, but Cricket didn't go out and build their own cell towers. They're using other people's cell towers who collect fees from that. Generally, those wind up either in Verizon's hands or AT&T hands or Sprint Mobile, right? One of the three. But the interesting thing is that, so you think about that, right? What are people going to cut out when you're going into a recession? Are they going to cut their phone out? Or are they going to cut eating out at McDonald's? Probably cut eating out at McDonald's, you would think. And look, eating at McDonald's is not cheap anymore.
No.
Still not that good of food, but it's not cheap anymore either. So it's not cheap food. And we'll talk about Whataburger later. But their phone, they're going to hang on to that. And I thought it was interesting in today's earnings announcements, McDonald's beat earnings and revenue, Verizon missed. And it almost, you almost kind of just expect that it would be the other way around. It wasn't. So, but remember, as we said, we've already lowered these earnings expectations so much since June of last year that companies are barely beating these numbers. And so again, if we go back to last year and say, well, what were earnings estimates for McDonald's last June? They were dramatically higher. McDonald's missed hugely their revenues and earnings numbers based on initial expectations. Verizon, disaster relative to initial expectations. But again, just because we've lowered them so much, these companies are barely missing earnings and revenues, or barely beating them earnings and revenues over those much lower, dramatically lowered estimates. And so that doesn't really tell you a whole lot about where we are in the economy because you're beating these very much lowered estimates. But it's interesting because from that standpoint, though, markets are trying to price in, okay, is this the worst that we've done? And markets really, as we said, not going anywhere over the last couple of weeks. It's kind of really, well, actually it's been about 3 weeks. We really haven't gone anywhere. Markets are kind of stuck here. And earnings, according to the beats so far, aren't terrible. So what does that mean for markets going from here? And again, if earnings estimates start to improve from here, which is what S&P is expecting, then markets are going to have to start pricing in improving earnings on this backdrop of weaker economic data. It's a very confusing situation.
Indeed. So, and I think what the markets are voicing is the same consternation. They're waiting. How many days have we had where the market is, at its most up or down? The S&P is up or down 10 or 15 points and closes flat. It'll open down. Today it's going to open down about 20 points. And it'll probably close within a couple pennies of flat, of zero, right? And there have been other days where it's up 20 and it ends up a couple pennies of flat. So what does that tell you? To me, that tells me that investors are comfortable. The bulls and the bears are equally motivated to buy and sell. And they kind of found a nice, good ground, level ground here. No one is more empowered, more motivated to sell than the other, and we're just going to spin our wheels. And the question is, how long are we going to spin our wheels? And again, I think it comes, assuming the banking crisis doesn't come up, assuming, something doesn't happen with Russia, with China. There's a bunch of things that
outlier
can happen.
events. Yeah, well, that's the thing. We'll talk, and let's talk about that when we come back from the break. But actually, a very interesting comment to that actually came out of JP Morgan this morning on that front about what you're just talking about, defending markets. We'll talk about that when we come back from the break as well. I'm Real Lance Roberts. Michael Lee, what's joining me this morning? We'll be right back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know, money changes everything. I'm just sitting here reading the headline. A changed Taliban says it's welcoming women's rights and now wants $10 billion from the U.S. You really can't make this kind of stuff up. I'm just saying. Wait, there's money if I'm good? Okay. Apparently my kids are now the Taliban. I'll be good if you give me money.
Until they get the money.
And then they turn back into the Taliban.
The Real Investment Show podcast. Same show.
That's my kids.
At realinvestmentadvice.com.
They've been terrorizing me for years. Anyway.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just for the break, Mike and I just kind of touching on this, kind of interesting market that we've been in, because despite one kind of piece of bad news after another, market's really just kind of trading flat. Really have been kind of trading flat since March of last year, other than one little brief, drawdown in October of last year. Market's about where they were a year ago. So, despite all of the angst, news, headlines, bad news, etc., market's really holding up fairly well here. And I thought it was interesting here over the last, as Mike was talking about just for the break, it's been kind of interesting the last few days, because the market would end up, might open up 20 points and then end flat, might open down 20 points within just a few pennies of being flat for the day. And JP Morgan had an interesting statement on that point. The tone is changing into something a little more constructive within the markets. Holders are defending underperforming stocks early, and short sellers are slow, passive in pace. It could be that we're now through. It could be now that we're through 20% of the S&P 500 earnings, and it's not terrible. that equities remain largely underowned, although off recent levels, and the fear that the consumer base is weakening, a main driver of a recession, appears to be waning. On the macro side, the number of reasons to be bearish on equities remains significantly longer than those to be bullish, but some of those negatives are beginning to trend into more neutral, positive territory. So I thought that was kind of an interesting comment, because that's also kind of what the markets have been telling us, is that, the worst, there's still, a lot of indicators. And again, lots of bullish headlines every day. And I'm not arguing these points. Inverted yield curves, leading economic indicators, certainly long list, as he says, a long list of reasons to be bearish. But there's other indicators that are starting to say maybe the worst of that's behind us. And again, the one thing to remember, markets are about sentiment more than data. And markets price in things. In other words, if you take the global pool of investors, and that's all the market is a living, breathing organism, and it's buyers and sellers that are all in this marketplace. And if markets are aware of a situation, then they begin looking through that to, well, what happens next? What comes after that? And then if there's an improvement on the other side of whatever that indicator is, and if we start seeing an improvement in the environment that will eventually feed into whatever indicator that is, that's going to give buyers a reason to step up and buy early, because they want to try to buy the bottom, right? Everybody wants to try to buy low and sell high. We try to do that. Most people fail miserably, even we wind up buying high and selling low. But that's the way markets should work. So the question we have to ask ourselves is the market already looking through whatever this is? And as we begin to see improvement in some of these other indicators, do we need to be paying more attention to those, waiting for some of these other lagging indicators to catch up? That's going to be the question.
And we still have the Fed, right?
Right.
There's still this lag effect that we used to talk about all the time. We haven't talked about as much.
Right.
The lag effect is still a real thing. And a lot of those rate cuts from last year, not even talking about what they've done this year, still have yet to fully impact the economy. So as that will also work itself through. But Lance, you've talked about these rolling recessions.
Yeah.
It's quite possible that we're doing some healing while, as opposed to everything hitting all at once, parts of the economy are healing while other parts are growing, other parts are shrinking. And net, some company may lay off, we've seen in the tech sector, Microsoft, Apple, they've been laying off employees, but we've seen in aggregate, those employees get picked up elsewhere. So the macroeconomic effect has been minimal.
Right. Well, and also to remember, particularly in the tech sector, they were on a wild hiring spree in 2020, 2021. And so a lot of their layoffs are just getting them back to their normal employment levels, right? They're not drastically cutting headcount. They're just kind of getting back down to where they should be anyway.
Right.
But let's flip the script here, because there's just a couple other big important points that will ultimately affect the markets, obviously. Right. And one of those is this debt ceiling debate. And again, as we start there's what's called the X date. This is the big thing everybody's paying attention to, right? It was like the moment that the government runs out of money and we're going to default on our debt and it's going to be terrible. And lately there's been this divergence between the yield on a 1-month T-bill and a 3-month T-bill. And this has gotten a lot of people running around on financial media saying, oh, that's clear sign that something's just about to break and everything's about to go to hell in a handbasket. You better own gold. Generally, those are people trying to sell you gold. But, this has kind of been one of those big, kind of moments that somebody's tagged onto and is trying to extrapolate this divergence between yields into something that maybe it's an issue, but maybe it's not. And this is the problem with these things, and how and what leads us into making bad financial decisions ultimately with our money is extrapolating a anomaly into something that it may or may not be. And part of this has to do with the X date and how the government's going to react and the default on the Treasury. So I want to go through a couple of these issues, because there's a lot of false information that's kind of running around. And it's not that could we default on our debt? Yes, it's entirely possible. We have defaulted on our debt before, a couple of times. We did it back in the 1920s, and we did it in the 70s. And in the 70s, there was a technical glitch with the Treasury Department, and payments went out, I think, 3 to 5 days late than they should have been. So technically, yes, we defaulted on our debt because we did not make our interest payment. When you do not make the interest payment on your debt, that is a default. You cure that default by making the interest payment on your debt. There is a very big difference between defaulting on an interest payment and defaulting on your debt. If you don't make your principal payment to the bank, you just say, hey, you know what, bank, I borrowed $1 million from you and I'm not paying you back. That's the bank's problem at $1 million, by the way.
You can do the rest of the joke.
Exactly. You know the rest of the joke. But that's a default, right? So now the lender is out their money. That is a full default, and that's a bad thing. We're not talking about a default of not paying our principal payments on our debt. We're talking about the potential we might miss an interest payment by a few days because of this X date. And again, this happened back in the 70s. We were late. Yes, we technically defaulted. The world did not end. Oh, and by the way, people bought treasury bonds. Yields fail when we actually defaulted on our debt. People were buying treasury bonds at that point because they knew the interest payment was going to get made, even though it was late. That's what we're talking about here, potentially. And I doubt even that happens. But before I get too much further into this, Mike, this spread between the 1 month and the 3 month T-bill yields, is it a big of a concern as people are trying to make it out to be?
No. Again, I think for the same reasons you're saying. First of all, a default happens when an interest payment isn't made. A default does not happen when a Social Security payment isn't made, when the national parks aren't paid, when the post office isn't paid. It's just the interest. And so what the markets are trying to suss out is it possible that payments will be late? I don't think anyone in these markets thinks the Treasury is just going to say, oh, we're done. Here are the keys. Jingle mail.
Yeah, here's your country. You can have it back now.
Right.
Although there may be a need for that. Anyway, give it back to England.
But here's the thing. If they are going to be a couple days late on a payment, which I doubt, but it could happen, never say never, it affects a very short-term security a lot more than a long-term security. So an investor would, if they are going to default on an interest payment, you'd rather be on a 30-year loan as opposed to a really short loan because that constitutes a big portion of the time. Right. So what's going on now is the 1 month Treasury bill is trading, and it's whipping around by 30 basis points, if not more. So I could be dead wrong when I say this, but it was trading around 3.5%, and the 3 month Treasury bill is trading close to 5%. So you look at it and you say, well, why would anyone buy a 1 month bill when they could buy a 3 month bill and earn an extra basically 1.5%? And the answer is no one in their right mind would. And no one is being forced to. This isn't investors that don't really know what they're doing and they're taking their money out of banks and putting it into 1 month bills. Most of them buy money market funds. And when you buy a money market fund, the money market fund is trying to get the best rate possible. And they have other tools. They can buy 2 month Treasury bills. They can put their money in repo, which we've talked about, with the Federal Reserve, and earn 4.5%, 4.75%. So there are plenty of options. And if the only other option was a 3 month, we'd see the 3 month yield dropping similar to the 1 month yield. So what this is that treasuries are used as collateral for investments. So when hedge funds, when all kinds of institutions use leverage, they have to post collateral. And if something ever happens with that loan, the bank can take that collateral. And from what I hear is going on is that the banks are saying, we want the collateral to be all 1 month Treasury bills or shorter because we don't want to deal with this debt cap and the implications of a missed payment and what that may mean for the collateral itself. Because if they do actually miss payments, the markets will probably go haywire for a few days. And that's where they want that good, safe collateral in case something happens.
Right. And so again, the important thing here is not to extrapolate what's going on with the spread between yields as something that is pertaining to a massive debt default, even if we do miss the payment. As soon as the debt ceiling cap is lifted and resolved, and look, everybody's eventually going to vote for the debt ceiling, to lift the debt ceiling, because nobody wants that on their political record that the government defaulted on debt because of them, right? It's politically bad. So it'll get done, but even if we're a little late, as soon as it's raised, the federal funding all gets put back into place, bonds are issued, and interest payments are made. That's it. It's nothing really to worry about. Be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Thursday, May 11th, with Danny Ratliff and Richard Rosso. How will Medicare work with the insurance you already have? What are the deadlines you need to know for signing up for Medicare? Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Just to finish up on our conversation here on this debt ceiling limit and X date and all this, and again, there's going to be a vote this coming week on the debt ceiling, and I'm sure it's going to fail. And then they'll go back and everybody will get in their corner and they'll come up with some compromises, and they'll eventually get it lifted, and everything's going to be fine. And so again, the risk here, there's a couple of things that when it comes to bond investing in particular, and since I wanted to touch on this because this is my specialty. Investors are I see a lot of investors making a mistake right now. I see a lot of investors running out to buy 1 month, 3 month, 1 year T-bills, 2 year T-bills, because they're like, oh, look, I can lock in 4% on my money for the next 3 months, 6 months, 9 months, a year, 2 years, whatever it is. What are you going to do when that matures? Right? Because yields are already falling. And if you think that we're going to have a recession, and if you think the Fed is going to cut rates, yields are going to fall a lot more on the longer end of the curve. And so by the time in the next year, 6 months or a year or 2 years out, so great, you've locked in this 4% for the next year or two. That's awesome. But the problem is that when that matures, yields on everything are going to be heading towards zero, most likely at that point. And so what are you going to put your money into then? And if you're hiding in T-bills now because you think that there's a big economic crash coming, you don't want to be trying to move back into equities in the middle of that, right? So, one thing that you have to think about, and this is one thing I think investors, because again, look, we don't talk about bonds a lot. The mainstream media never covers bonds or anything else, and most people don't even know how bond work. They understand stocks as we talk about all day long, but nobody really understands how bonds work. But to me, if I want to be locking in a higher interest rate in my money, I want to buy as much duration. I want to keep that rate for as long as possible, right?
Right.
And that way I can always make a decision later that if yields fall towards zero, great. That means the price of my 30-year bond went up. And so now I just sell for the capital appreciation. I make a lot of money. If something goes wrong and yields don't fall for some reason, I've locked in 30 years worth of a 3.5 or 3.7% return. Not terrible, right? It's better than a sharp stick in the eye when you're getting basically zero. But go ahead.
Let me digress for a little bit.
All right.
A bond is very simple. A bond is just...
It's so complicated. They don't even cover it on television. That's how complicated it is.
It's a series of interest payments. I could take that sticky over there, Lance, and just write you an IOU bond, and it's just a series of numbers that will be paid or won't be paid. A stock is based on a series of cash flows based on their business and the millions of things that affect their business. Revenues go up, revenues go down, the economy goes up, the economy goes down, and all those cash flows move around. A bond is just a set fixed payment. So, if you spend a little time, you'll realize they're not that hard. But to your original point, yes, it's if you think this economy is going to follow the trend for the last 40 years, which has been slightly lower over time, back below 2%, and I'm not saying it's going to be at 2% in October, but over the next 5 years, there are many reasons that trend is intact, and there are many reasons to think that we will get right back to that trend. And usually you don't just get to the trend, you go into a recession and you kind of work around that trend. So yeah, you can lock in 5% for a 3-month Treasury bill now and sleep really comfortably earning 5%, but you can also lock into something, a 10-year bond or a 30-year bond at 3.5%, 3.75%. And yeah, over the next 3 months, your opportunity cost was better being a 3-month bill, but you're now locking in a yield that's almost double the growth rate of the nation, which has been almost impossible to do over the last 10, 15 years. And if inflation gets back to 2%, which we think it will over time, you're earning a real yield. So your purchasing power is increasing by 1.5%, 1.75% a year. That's something that has been to get any kind of positive real yield has been nearly impossible to do over the last, since the financial crisis. And a spread of that much was even hard before the financial crisis. So look, if you own a 10 or 30-year bond, it's not necessarily pleasant because the price does move up and down, and there are some unrealized losses that can occur. But at the end of the day, you're looking at an economy that's really a 1.5% to 2% economy. And that's not Lance and I saying that. The Federal Reserve's expectations are forecasting the same thing. If you look at the nation's productivity, if you look at the debt, if you kind of put in these big picture items, and they all point to growth rates sub 2%. They all point to inflation rates of sub 2%. And you can earn for up to 30 years almost 2% more than that. You're supposed to jump on that and deal with the short-term gyrations in price.
So anyway, that's the important thing here, and I'm gonna have an article coming out on this as well. And Mike touched on a very important point that is tied right back to this whole debt ceiling debate, which is the trend of growth in the economy has been slower over time. And that's because of the debt and the deficits. Interest rates are a function of economic growth and inflation. So, and on the long end of the curve. Now, on the short end of the curve, it has a lot to do with just psychology of economy and markets and Fed and all that. And Fed controls the short end of the curve. But long duration bonds, 10-year, 20-year, 30-year bonds, that is economic growth and inflation and wages ultimately. And there's a very high correlation between those data points over time. And that's simply a function of economic growth. Obviously, if economic growth is slowing, then yields are going to fall because of the ability to repay debt and what people will borrow debt for in a slower growth environment. That's just the way it works. So again, to Mike's point, you have to look at the bigger picture of this and not get so swept up into these short-term headlines, because you miss a lot of opportunity that you could be penalized for in the not too distant future. So just be careful. If you want to buy bonds, it's great. Just be careful running out just to grab a 1-year bond, unless your expectation. Now, 1-year bonds are fine, or 6-month bonds are fine, 3-month bonds are fine. if your anticipation is that in 3 months or 6 months, you're then going to move that money into equities because the bear market's going to be behind us and you want to own equities for a higher return. That's okay. So it's all about duration and understanding just importantly, what happened if you're going to make this move to buy something? What is your next move after that? Investing is a lot like chess. You've got to be thinking ahead. I'm going to do this move now, but my next move is going to be this. And if this occurs and if this outcome happens, how am I going to respond? You need to be thinking ahead rather than just, oh my gosh, I think there's something bad happening. I'm going to go jump into something ultra defensive. That could wind up even penalizing you more longer term than whatever the event was you were worried about to start with.
And likewise with the longer term bonds too. They don't have to be held for 10 or 30 years. You can hold them for a year. Let's say yields go down to 2%. You can make 10, 15, 20, 30% on the bond. And at that point, say stocks are significantly lower, use those gains and buy stocks at a deep discount. So it's all about the choices that you're making and how much volatility you're willing to take in the short run and these big macro drivers of the economy in the longer run. And they all come together to help you understand what will happen and how to take advantage of it. And from that, you you play with your risk tolerance and how much risk you're willing to take. And there are some really good opportunities out there.
Right. Just a quick gear shift here. One of the topics that has been floating around lately is commercial real estate crises, right? And this is the next shoe to drop is commercial real estate. Just thought it was interesting this morning. Sam Zell, who is a billionaire real estate mogul, and he's the guru of real estate. Whenever he's the Warren Buffett of real estate. And, so when you want to know something about real estate, you talk to Sam Zell. It was interesting that he was doing a speech at the New York University Shack Institute of Real Estate, and it's their annual REIT symposium. And he was asked, he was like, well, what do you think, this work from home trend, what does that mean for commercial real estate? And is that here to stay? He said, one of the biggest lies in the world is that people working from home are more productive than people working in the office. He says you have much less productivity if you're working from home in your pajamas with 3 little kids running around than you are in an office. I wouldn't want to be an owner of commercial real estate Class B properties right now. Swipe data from Castle Systems shows that office occupancy is about 46%, well below pre-pandemic levels. And he said there's an enormous difference between a Zoom board meeting and meeting in person. A Zoom board meeting is a meeting where everybody sits around and listens to recitations. In an in-person meeting is where real discussions take place. So his point, though, is that and a lot of companies that have all this commercial real estate, they're eventually going to, this work from home, hybrid, all that will eventually end. It's going to take some time, but that will all move back into commercial real estate spaces. So again,
and that ties to employment. Yeah. Once the unemployment rate starts rising, people are going to be, I got to get back in the office. These guys need to know who I am.
Exactly. It's super easy to get fired over Zoom, by the way.
Right. And it's also easier to get promoted and to get raises when you actually are in the office and show your face. And are there.
I mean, if you're the owner of a company, who are you going to keep around? The guy that's showing up in the office every day and being present and not just
and about his family and his financial situation versus some face on a Zoom screen.
Exactly. So this will all change as always, but it's always interesting. Sam Zell always has very blunt, to the point comments.
And that's why I'm here today, to save my spot on the Thursday show.
Exactly. All right, that wraps up the show for today. Get by the website, realinvestmentadvice.com. Sell in April, just because it's May, and that's on the website now. And we kind of go through the reasons why we were taking profits recently. Also, by the way, sell in May doesn't mean sell everything and go away. It just means might want to reduce your risk a little bit for the summer. Lots of stuff ahead of us. Of course, that's on the website now at realinvestmentadvice.com. We'll be back tomorrow, of course, for the Wednesday edition. Danny Ratliff will join me in the morning. Have a great day. We'll see you then.